We are here in Singapore this week with our global partners from across the world. We are meeting clients from Asia, from Singapore, clients from Europe, clients from Latin America and so on. But we also have Pascal Saint-Amans with us in the last 2 days, looking back on how Pillar 2 implementation, BEPS implementation went in the last 10 years. We did a look forward during a breakfast session already. And we wanted to take benefit, Pascal, to further elaborate on the future of taxation with you. And it's actually my friend Janis Taukas who will take the lead from Latvia, who is our senior partner in the firm in Sorainen. Has a podcast, 49 sessions, I heard, or you don't call it sessions, I think, Janis, but
episodes, yeah.
Episodes is a better word.
Whatever.
And so you will guide us through a few extra views with Pascal on the future of taxation, looking back a little bit, but certainly looking forward on where we are going and how the table will further shift. And we both read your book, Pascal. It's still in French. I think you read it in French as well, Janis, but so we both read it, and that is basically the legacy, the history that you made, and but we're going to start from there, so where it will lead us afterwards. So I leave it to you, Janis, to kick it off, and thank you again, Pascal, for taking this invitation.
Thank you, Wim. Pascal, I have a feeling that I'm speaking with the Pope of the tax world, so I will...
Bless you.
At Brunswick, you help companies to present the financial statements and tax reporting in a reader-friendly language. Is this a new normal, that media risks are so high that companies should explain their taxes, and what are the best techniques of explaining so?
Is it new? It's not really new. It's been more than 10 years that you have a lot of media and public attention to tax affairs. You remember 2012, in the fall, you had demonstrations in London. You had the Prime Minister of the UK, now by the way, Foreign Affairs Minister, saying companies should smell the coffee, because it was a reference to a large company selling coffee, which had issues with its tax affairs. So there has been, for a long time now, a lot of public attention to tax affairs of companies, of large companies. And what's interesting is that it's not going away. So it's not new, and it's not going away. And I don't see it going away, because we're still in a crisis mode. 2008 is the global financial crisis, followed by a fiscal crisis, followed by a social crisis. We're now in the political crisis mode of this cycle. And people are still angry with large companies not paying their fair share of tax, in spite of all the progress made at the OECD. You have the global south pretending no progress was made. So Brazil, South Africa, but also African countries in general think that not enough was made. So tax is still a hot topic, and that's why I think companies should not only change their behavior, I mean, most of them have, I believe, but also explain it to the public. And the publicity of country-by-country reporting in Europe as of 2025 on 2024 account will be a good test on whether they are ready or not, whether they've changed or not, and whether they're ready to translate tax language, you know, an Excel sheet which is almost impossible to understand, into a plain English type of explanation, which is, by the way, what I'm doing at Brunswick, which is a communication public relation firm turning into a critical issue advisory firm, because we believe that tax is a critical issue for companies.
And are boards willing and CFOs willing to take that stand and really communicate differently than in the past? Do you see there a trend shift already, or is it still convincing that they need to communicate better and more?
I think there is already a shift, but it's limited. It's much more limited than it should be. It's been almost 15 years. I mean, when I joined the OECD back in 2007, there were some large accounting firms advocating for tax should be in the boardroom. And it's still not in the boardroom. So it has to get there. I think the country-by-country reporting, the publicity of CBCR, is a good opportunity for companies, for the tax people in companies to tell their CFO and their CEO, listen, this is our tax policy. And the tax policy consisting of saying we are compliant with all the laws and regulations of the countries where we operate doesn't mean anything. It doesn't mean anything because it means you're not a criminal. Yeah, I mean, hopefully so, right? So you need to say more, and it's not easy. And the reason why it's not easy is that tax lawyers, I mean, our community knows about compliance. It's compliant or not compliant. It's legal or it's not legal. Where the public expectation is on another level. Public expectation is about fairness, but tax people don't know about fairness. I mean, it's not legal language. And that's precisely that gap which needs to be bridged, and it has to be bridged by the CEOs, I believe, by the board members, so that they translate into a tax policy what has been the practice of the tax people, cleaning up the bad behavior or the too aggressive behavior which has no room left in today's world.
On another note, I was recently attending a Nordic Business Forum in Helsinki, and there I saw three major threats to businesses and to people in general. So one was war, the other was all environmental stuff, ESG, and artificial intelligence. So let's talk about those two. If we talk about artificial intelligence, in his book Scary Smart, Bo Goddard describes Google Exchange functions where an AI machine is selling to another AI machine, and person and their data is a product. Are we far away from taxing data transfers like Italy is trying with Facebook or in some other form?
So that's been a debate. I think it was kind of decided a few years ago. I mean, when we started the BEPS work, for BEPS standing for Base Erosion Profit Shifting, which is the big project we launched back in 2012 to try to patch the system so that companies would not benefit from loopholes in international tax rules, there was an issue with the digitalization of the economy. And some at that point, in particular in France, you had two civil servants in France writing a report to the government saying we should move towards taxing data because the new gold is data. So American companies are extracting data from Europe as European companies have extracted minerals from Africa, and we should tax this new gold. And there has been an in-depth reflection on that, and the end conclusion was actually not really, because what gives value to the data is the processing of the data. That's where the value is. So I think countries have moved away from taxing data as such, and they have not yet found the magic recipe there, because you need probably to change existing rules, the arm's length principle, and that's what Pillar 1 does. Pillar 1 is a new set of rules, not yet fully adopted or not yet translated into a multilateral convention, which provides for market jurisdictions to get more of the taxing right. Now, if we go back to data, what is a market jurisdiction for Google or for tech companies? It's the country where you generate the revenue for advertisement, if you take that business model. So let's take Europe, but we could do the same in Asia, taking Singapore instead of Ireland for Europe. But let's take Europe. You have Latvia or France or Germany. People will make advertisement for Google or any other such business model. The advertisement will be booked in Ireland or here in the region in Singapore. And the market, which is the place where the advertisement was generated, because that's where the restaurant doing the advertisement is located, is frustrated not having the taxing right. So it's not really data that you will tax, but it's the market, because the only thing you cannot shift in any business model is where your final customers are, right? Where your client base is. You can shift the factories, you can shift labor, you can shift profit very easily, you can shift the intellectual property. The thing you cannot shift is the client base, and anchoring taxing rights where the market is a very robust way against profit shifting. So you see, I'm making the link between artificial intelligence, data, and at the end of the day, the marketplace where, according to me, the international tax system is moving towards.
And in that respect, what will win, Pillar 1 or digital services tax?
That's a good question. At the end, the winner will be Pillar 1, or will be a move towards destination, will be a multilateral agreement. I think everybody agrees with that, but we're not yet there. We're not yet there for two main reasons. I mean, one is a dysfunctioning United States. The US has recognized that the current system is broken. That's what they said on the 8th of October 21, by joining Pillar 1 and Pillar 2, the two-pillar solution. They basically said the current system is broken and doesn't allocate taxing right properly, which is not only a Biden thing, as some in the US would say. This was started by the Republicans during the tax reform, because the ones who introduced a global minimum tax to a move towards destination were the Republicans during the tax reform. You may remember that the House in June 17 adopted the destination-based cash flow tax, which was this move towards destination. Now, the US says, the current system doesn't work, we should move to destination. It's a bipartisan approach, actually, in fact, but they're not able to ratify it. And that's where you have the risk of frustrating other countries, which say, you do recognize that the system is broken, you do recognize that we should have, as market countries, you as well, the US, more taxing right, but you don't sign on what you've agreed, and therefore what is left to us is a proxy to this Pillar 1, to this new reallocation of taxing right, and the proxy are digital service taxes or significant economic presence, which are not good taxes. I mean, these are bad moves, but from a political perspective, it's easy to say that it's going to be a Google tax, even though it is not a Google tax. It's a tax on the clients of Google. So there is a fight to come in the coming years. The international community has bought time by saying we're negotiating. We'll see whether the US signs the multilateral convention to implement Pillar 1. That may buy more time. We'll see that in the coming weeks. If they sign, maybe more time will be bought. If they don't sign, maybe some countries will pull the trigger on digital service taxes, which may result only in chaos or hard time. But we may need to go through that phase before finding a multilateral solution. So we need to monitor that closely.
And sticking with AI, do you see any other advancements of AI in taxation field, either with the tax authorities or with taxpayers?
I think that's where it is. I believe that AI will probably replace a number of advisory jobs. I mean, not the high value advice, but the compliance work can probably be done. I mean, WTS had a good showcase on this over the past 2 days, and I think that's probably the future, as is the case in many service jobs where AI could replace some of the job currently performed by people. But I'm positive in the sense that it will probably allow us, human beings, to concentrate on higher value and more complex thinking. You know, AI may think out of the box. I believe human brain will be the one thinking out of the box. And that's what we need. If you want to improve systems, if you want to be efficient, actually what you need to do are bespoke solutions which require to think out of the box.
And the other topic, ESG and carbon taxes. There are massive subsidies in the US. How do EU tax systems look globally versus the rest of the world in that respect? Are they competitive, and where the government should focus regarding ESG-related taxation?
So you're absolutely right. I mean, climate change is the big thing for those who believe in climate change. Unfortunately, this is not completely shared, in particular in the US. But the energy transition, which has started, is defining the next 10 years. And this will have an impact on tax systems. This will have an impact on subsidies. This will have an impact on trade. And this will have an impact on tax. So if we start with tax, it's about carbon pricing. Today, I think it's 60% of carbon emissions which are not priced at all. No emission trading system, no carbon tax. The remaining 40%, and I'm talking about global emissions for more than 90% of global emissions, so G20, OECD, and a number of African countries. The remaining 40%, the price tag on carbon emission is on average at €5. So 60% nothing, 40% 5, when I don't know what the right price tag should be, but probably above €100 per ton. So carbon is not priced. There are reasons for that. If you try to price carbon, you have a revolution. You have the yellow jackets in the French streets. You lose the next election. And why is it so? Because carbon taxation is regressive. So the political economy of the reform here is extremely difficult. And that's why a number of countries are not moving. They're trying. Even China is trying to put in place some ETS, emission trading system. Europe is the most advanced there with an ETS1, emission trading system covering the large industries, and soon a second emission trading system on more granular client-facing type of emissions. And they have also a carbon tax. And that's why, because they're tightening their emission trading system by removing free quotas, they are putting in place a carbon border adjustment mechanism, which may trigger some trade tensions. And so you have a real issue with moving to carbon pricing. Political economy is extremely difficult, but you have a critical mass of countries with Europe doing that. And the US, on the other hand, has so much money that they are pouring money on the industries with the Inflation Reduction Act, which, by the way, is not an act on reducing inflation. It will increase inflation, but it's about subsidizing massively in a selfish manner, because it's going to harm other countries, because industries may go to the US. So this is probably the most important thing, much more important than all the corporate income tax that we've talked about so far.
But it's indeed, Pascal, it's very fragmented. And indeed, it depends continent on continent on how it's dealt with. Shouldn't there be, like you did on corporate taxation, be like a global view, a global initiative at OECD or at another level to really drive that agenda? Is the agenda owned on carbon pricing somewhere from a global point of view at this point?
No, it is not. Yeah. It's fascinating. The Paris Agreement doesn't include anything on carbon pricing. So the words carbon pricing are absent from the Paris Agreement, and the UN Ep.50 mechanism doesn't include a monitoring on carbon pricing. I tried when I was at the OECD to bring it to the G20. And guess what? Countries said, no, we're not ready. So China in 16 hesitated, didn't take it. Germany in 17 wanted to take it, but Trump was elected in the White House, was not the right moment to talk about that. And then Argentina didn't want to touch it, and then we had Saudi Arabia, which said, hey, sorry, I mean, Japan and Saudi Arabia said, we don't want. It's only under the Italian presidency of the G20 in 2021 that we had a tax symposium at the G20 to talk about that. And I was very excited. After 5 years of efforts, I managed to get that. And the tax symposium was inaugurated by Madame Yellen, the Secretary for Treasury of the US, who started with the following statement. She said, as an economist, I must say that the only way to organize the energy transition is to tax carbon. So I had a big smile. But she did put a comma and continued. As the Secretary for Treasury in the US, I can tell you it's not going to happen because politically it's impossible. And then I lost my smile. And Liu Kun, the finance minister of China, was more or less on the same line. So countries are not ready. What we tried to do was just to put on the agenda the issue of carbon pricing, to tell finance ministers of the G20 every 6 months, look, it's not taxed. There is an issue. But even that was too much of a stretch for them to agree. So we're not able to do that. In spite of this relative failure, the Secretary General of the OECD, Matthias Cormann, decided to establish an inclusive forum on carbon mitigation approaches, IFCMA. So the very title, which is a bit complex, Inclusive Forum on Carbon Mitigation Approaches, means that naming carbon pricing is too difficult. Carbon mitigation approaches is to say you have different ways to price carbon. Direct, by putting a price, or indirect, and the regulation is an indirect way of putting a price. If you say no thermic cars by 2035, you can try to determine what's the equivalent price, which would result in the same outcome. And what's very interesting is that regulations are very effective, they deliver, but they're not very efficient because they deliver at a price which is probably much higher than what an explicit price would give. But that's the way to go. What I believe is that we will need both, so we need to keep the pressure. At some point, it will belong to someone. I doubt that the UN will take over. The OECD could do it. I don't see the UN tax committee moving there, but it will have to take place because countries will have to move there. There is an emergency. It's not addressed as an emergency, but at some point it will come.
We're here in Singapore, and this week we were drinking beer with friends and chatting. How's that Singapore got so developed in just one generation? Is this a general trend that Europe is lagging behind Asia, and why? What countries in Europe should do about this?
That's a very large question and a very good one. I think Singapore has primarily benefited from its geographical location as a bridge between Europe, the US, and China, which has been the growing market. So growth has been in this region for years. Now, Singapore has been quite unique in taking advantage of that. Tax has been part of the strategy, and it was an important part of the strategy, but only a part. And we heard people from the Ministry of Finance and Economic Development who indicated that tax was only one part of this. The ease of doing business in Singapore is absolutely impressive. The agility of Singapore to adapt to international regulation, to anticipate them, and to offer a fantastic environment for doing business, in addition to a low level of taxation. So it's been a global offer. And I would add to that this unique sense of building a nation which had to struggle with a difficult environment. All that is part of the recipe for success for Singapore.
Do you see any good benchmarks for the countries regarding the tax systems and tax authorities like Singapore or anything else? Where do you suggest to look at for countries?
So that's a good. So for tax administrations, there should be a benchmark. Tax administrations are very reluctant to give the data to be benchmarked. I mean, if you're a tax commissioner, we tried at the OECD with from on tax administration to say, give us the data, we'll benchmark you. If you're a tax commissioner, you don't want to be benchmarked, right? But you can find some hints here and there in the FTA report. As regards the tax system, which is very different, I think we tax people often forget that tax is a means to fund society, right? So what you need to look at is not the tax system per se, is what does it finance? And then is it the appropriate tax mix for the social model which was elected by the people? So if you take Nordic countries, Sweden will be very different from Ireland, from Spain, and from a developing country, right? Or from the US, where you privatize most of the activities, where in Sweden you will make them public. So the tax to GDP ratio in the US is at 24%, I believe. In Sweden is above 45%. And the tax policy mix cannot be the same. So you first need to look at the social model, and based on the social model, then you can try to identify what's the right policy mix between taxes which will yield revenue, like VAT, but which are a bit regressive, and progressive taxation. And here again, it depends on the appetite of the society for equality. In France, we're obsessed with equality, so you need very progressive taxes. You have countries which are less sensitive to these issues. So there is no one-size-fits-all answer. It really depends on the social model, and I think we tax people, we should always keep in mind that what matters at the end of the day is the public spending, and if you talk about this public spending, is what's the level of satisfaction of the people with the public spending. Sweden, they're probably happier than the French, who socialize 47% of the wealth, the GDP, and are not happy with the spending. So you need to combine all these elements to have the right answer, and that's why the right answer is a difficult one.
Let's talk about your book a little bit.
Good.
Tax Havens, how we changed the course of history, and it, to a large extent, describes the process of BEPS and Pillar 2 creation behind the scenes. Will the complexity of Pillar 2 pay off, and were there any alternatives of Pillar 2 during the discussions?
So first, thanks for mentioning the book. It's still in French, but it's being translated into English. And what I try to do is to explain to the public, including non-tax people, so it's in simple terms, but it's not simplified. I think you find all the complexity of tax, but explained in simple terms. What was the kitchen where we prepared all these meals, sometimes heavy meals, so you're in the kitchen with me, you're in the room with the finance ministers of the G20, or in the room at the Committee on Fiscal Affairs when we're negotiating, or in the bilateral meetings with finance ministers and so. And the book explains the past 15 years, starting with the end of bank secrecy, imposing transparency to all the countries which used to have bank secrecy, like Singapore. Then the move towards BEPS, which was a way to change the paradigm in terms of taxing companies instead of letting it go and letting aggressive tax schemes prevail, saying, no, we need to stop that, to the following step, which is the so-called two-pillar solution, which emerged, and that's what I describe in the book, which emerged in 2017 with the US tax reform. Trump and the Republicans passed a tax reform. The previous one was by Reagan in the 80s. And the tax reform was about lowering the rate of corporate income tax, which was the highest in the OECD. I mean, the Americans beating the French on the level of tax rate was not acceptable to Republicans, so they had to slash it to 21%, but they had to broaden the tax base. And to broaden the tax base, they looked at different solutions. We mentioned earlier the destination-based cash flow tax as one of them. They didn't go there because it was too bold a move, I think. Instead, what they did was to implement BEPS and introduce the idea of a minimum tax and a vote of non-confidence to the arm's length principle. So the minimum tax, which nobody thought would ever be possible, was made possible by the US and by the fact that it was the Republicans in the US who enacted it. And then the Europeans, I mean, just dropped on that and said, well, we want the same in better meaning jurisdictional blending. So you look at the effective tax rate of a company on a country-by-country basis, and you take the difference when in a country it's below 15%, while guilty, the global minimum tax in the US was on a worldwide average, which left room for arbitrage. You could still leave some money in low-tax countries. So was there any alternative in the conversation? The answer is no, because it came as an evidence, as something obvious when the US enacted it. I would make the comparison with FATCA, the Foreign Account Tax Compliance Act, and automatic exchange of information. The day the US in 2011, I believe, adopted FATCA, all the other countries said, we want the same, we want automatic exchange of information.
Jumping a little bit back to the Pillar 2 questions, I understand that you were saying before that the main purpose of this all was to avoid race to the bottom by the countries. But how about those countries who rely on businesses under the 750 million euro threshold? So are they left to drown to the race to the bottom?
So there is a threshold which is 750 million euros for in-scope companies. With that threshold, I think you cover around 9,000 to 10,000 companies, representing probably over 85% of the profits made by multinational companies in the world. So that's the bulk of it, right? The remaining multinational companies, that's a small amount. So that's not where the big rents are. And so the fact that these companies may not be subject to the minimum tax, I don't think it's a major issue, especially if you factor in the subject to tax rule that we haven't talked about. Pillar 2 is made of two components. You have the subject to tax rule and the globe rules. The globe rules are the minimum tax. Subject to tax rule does not have a threshold. And is kind of imposing a nominal rate of 9% on all businesses, including the out-of-scope businesses. That's why a country like the UAE, for instance, is enacting a new corporate income tax at 9%. If you look at what Barbados is doing, there will be a new normal rate of 9% and the QDMTT, a qualified domestic minimum tax, at 15%. So I'm not sure we can say that there is a big remaining pocket of untaxed profit, because one, it's not big, and two, with the subject to tax rule, it will probably be taxed at 9%, at least nominally.
Right. Let's do what Wim suggested. Let's look a little bit into the future, and let's say 5-10 years ahead. How do you see the future? Yesterday, we here at WTS Global meeting, you said that personal income tax might be the next thing OECD might try to fix. And in the book, you also mentioned VAT and tax collection that could also be improved. I like your, I will quote your, that you said it took the French tax authorities 3 years to understand that being friendly to a business is not a crime. So what exactly needs fixing? Would you elaborate on that?
Okay, so first, if we look forward, I would unfortunately start with the bleak picture of today. And that's a big picture and a bleak picture, which is we have reached a time of wars. There is war in Ukraine, there is war in Israel, and there are threats a bit everywhere. with populist movements on the rise almost everywhere, in Europe, but not only in Europe, with strong men a bit everywhere, and strong men, and not strong women. Women are more reasonable than men there, right? So we are at a time of risks and tensions. So I'm mentioning that because if you have further fragmentation, geopolitical fragmentation of the world, maybe all the tax work will collapse. It has not. Even the G20, in spite of the tension between, the obvious tension between the US and China, the tax work has remained good, in progress, and tax cooperation has not collapsed. But there is a risk there. So I would start with that. I really hope that we're touching the bottom now, and that we'll be able to move back to a more sensible approach and moving away from wars. I mean, so that's the first thing. Now, assuming we're not moving in the wrong direction, and if we look at the precedent of a financial crisis followed by a social crisis, fiscal crisis, political crisis, we're in the 30s. 1930s. Doesn't look good. So I really hope we move away from there. So if we move away from there, then we can talk tax, right? It's less serious. And if we talk tax, I think what will happen, hopefully, is a stabilization on corporate income tax. 15 years of work, the page the page of the old system has been turned. We have a new system. Pillar 1 still needs to happen. There will be ways for it to happen. And if it happens, with Pillar 2 being implemented, I believe that tax administrations will relax, will be able to turn to a better service to taxpayers, to streamlining the implementation, to use the information they will get, because now there is much more information. We talked about country by country reporting, but there is the global information return. So they will get the information. They will move to more prior agreement. I mean, APAs. Pillar 1 is kind of a mega APA, multilateral advanced pricing agreement. Simplified, by the way. I mean, the mechanics is difficult, but it's a formulary apportionment there. So I believe that tax administration should relax, should be more friendly to taxpayers, because taxpayers will not behave the way they did when the rules were broken. So that's the first part. The second part is linked to the economic situation, where you have an unprecedented level of inequalities in the world. The top 10% owns, I don't know, majority of the wealth on earth. The top 0.1%, 10%, something like that, of the wealth, it's broken. It's not sustainable. So tax, which is a powerful tool to reduce inequalities, will be used. So it's tax on capital. Tax on capital can be through inheritance duties. It can be through wealth tax, extremely difficult. I don't believe much in that, but it may be a way forward. Or tax on capital income, dividends, capital gains, and so. And all that may start with just trying to put an end to what one would call harmful tax practices at personal income tax. You know, the work on corporate income tax started in the mid-90s with a harmful tax competition project led by the G7 and the OECD. So I would see something there. And by the way, Brazil, which is taking over the presidency of the G20 in December this year, 23, to lead the G20 in 24, has put the issue of inequalities high on the agenda, and international tax as part of it. So let's see what comes out of that. But I believe, with South Africa being the following presidency of the G20, that this will be on the agenda, and it will be on the agenda of countries domestically. They need to do something. So I don't know what form it will take, but definitely there will be something there. And then the last block is probably about what we've just discussed before, which is carbon pricing, or the impact of the European move towards carbon pricing on other countries. Last, and it's a bit unclear what's going to happen there. But developing countries, I mean, we can no longer just talk about developed countries. We have emerging economies. I mean, we have developed countries, we have China, we have India, and we have the global south, right? And what's going to happen there? There is a question mark. There is a push to move the tax work to the UN. Something will happen on that field. I just hope it will not undermine the progress made at the OECD, but there may be an agenda to reflect the views of developing countries, the views and the needs of developing countries that the UN could embody and take on. So we'll have to see what happens there. I just hope that it will not bring further chaos to the situation, but complement the work. And the very last word is about domestic resource mobilization. It's one of the sustainable development goals. It was a key element of the Addis Ababa conference on financing for development back in 2015. There will soon be another conference on financing for development. And I believe that domestic resource mobilization is going to replace aid, ODA, which is in recess, which is not great to build states, to build democracies. If you look at African countries, the tax to GDP ratio is around 14%. It's much too low. Nobody knows what's the right level to ensure development. I guess it's around 20%, and we should hire PhDs to work on that and find
Ireland
the
22,
correlation.
yeah.
But it's probably above 20%. So developing countries need to assess their own taxes. They need to collect their own taxes. They need to build that system, this tax system, for also the accountability of their governments with their population. If you spend foreign aid, you're not accountable the same way as if you collect your own taxes. So I think DRM, domestic resource mobilization, is a big thing for developing countries.
Mm. And what does your crystal ball say about VAT and the tax authorities?
So on VAT, I mean, VAT is a tax which works, right? So do you need to do much more than what's happening today? I don't know, and I'm not a VAT guy. So you have two communities. You have the VAT guys who are very logic with systems which work pretty well, and you have the others. I think the international issue with VAT was imposing VAT on digital transaction, cross-border digital transaction. There is a standard. Countries are implementing it. So I'm not sure what's the room left to improve VAT from an international perspective. Improving VAT implementation by fighting the grey economy in developing countries in particular, that's key. And I think the digitalization of the economy is the best way to get there. So platforms and other digital services will improve the capacity of tax administrations to collect VAT. As regards tax administrations, artificial intelligence will be a game changer. The Forum on Tax Administration, which gathers more than 50 tax commissioners of different countries, adopted a report already 18 months ago on Administration 3.0, which is to move from, to do a leapfrog to a very digitalized administration, and combined with artificial intelligence, it may be a hopeful way to improve the service to taxpayers, to be taxpayer friendly while assessing the taxes properly. So that's definitely an important area ahead of us.
Mm. And what about the taxpayers, the head of tax? There's a lot of anxiety, and they want to be comfortable, they want to be calm about what's happening, but with all the changes, it's not going to happen. Do you have some medicine for them to get rid of their anxiety so that...
It's true that they have been facing fundamental policy changes for the past 15 years. And they may have the feeling that it never ends. And as soon as they comply with a new regulation, you have another new regulation coming up. So it's not been easy, especially as the old generations of taxpayers or tax directors, if you wish, were very much on compliance and a very lawyerish way of doing their job. and they were a bit lost when they were caught in the middle of a policy debate. And by the way, that's why I'm trying to develop at Lausanne University, where I'm a professor, a program of tax policy, because we need to teach tax professionals a dimension which is tax policy. It's not just about implementing the rule as it is. It's understanding how the rule was built, where it is heading, so that you can anticipate. And I think it's missing in the tax practice currently. So no, it's not an easy world. The cost of compliance is big, but as I indicated earlier, tax will move to the boardroom at some point, which should make the tax work more interesting in a sense, because it will be part of a policy. You mentioned ESG as an opening, and tax, I would say, is the silent T in ESG. It's part of an overall approach of companies to society, and so should it be. So tax directors have a role to play which is beyond the pure compliance.
And that, I think, is an inroad for me to leadership. And Pascal, you have led the biggest international tax transformation ever. You led your own team in Paris, which I understand was growing and growing, even with limited budget. You were at the tables of the G20, politics everywhere. What is your leadership insight, if I can use that word, also for next generations? I mean, bringing tax to the boardroom is one thing, moving from compliance to policy, what the work that you're doing in Lausanne. What are your insights there for future leaders? Because I believe we also have a huge leadership crisis. So it has to come from people who stand up and people who want to make the difference. Any insights from there, how you stood strong for 15 years in that transformation? What is the magic there?
Not easy to answer to that question. I would think that thinking out of the box is the recipe. I mean, what we need today is people who understand what it will be tomorrow. I don't, and I'm happy I left the OECD, because you need new blood and new brains who will be able to sense what's next. So maybe we haven't described it because we're not seeing it. So I think leadership is about questioning what you live through, what the facts are, and being able to reinvent a model as necessary. And maybe there is no need in tax to reinvent the model, or there will be a need somewhere in the scope. So I don't know. We'll see which tax leaders will emerge.
But there is a need for it, right? So
there is always a need for leadership. You know, at Brunswick, what we say is that you actually go through crises by leadership. When you face a crisis, when you face a change, what you need to show is leadership. The answer may be right or wrong, but you need leadership. You need to embrace the critical issues. You need to embrace the difficulties and go through them and not try to avoid them.
And that's where the difference is made at the end of the day.
Ladies and gentlemen, Pascal Saint-Amans, it's been an honor. I could listen to you for hours, but
thank you so much.
We're short of time, so thank you very much.
Real pleasure. Thank you.
Thanks for the time.